Hi, my name is Vivian Sairo and my matrix is 8248219. Today I will present about business nature of the company, Farm Fresh Berhad and Dutch Mills Industry Berhad. Farm Fresh is a local merchant brand. It makes fresh milk, yogurt, oat, and soy milk. The milk goes straight from their farms to the store, which is fresh. Farm Fresh cares about health, natural ingredients, and supporting local farming. They sell their products both in shops and online. The brand is great for people who want natural and healthy options. That's Ready, on the other hand, is a popular and long-established brand in Malaysia. It comes off from a bigger Dutch company called Friesland Campina. They offer many types of milk like UHT, favorite milk, yogurt drinks, and milk powder. Dutch tea products last longer and are sold almost everywhere. They target babies, children, and adults, and they often use advertising and promotion to reach more customers.
Assalamualaikum. My name is Nur Anshaira binti Muhammad Iskandar and my matric number is A24A3828. My part is horizontal analysis. So we will start with farm fresh per head. Number one is current ratio. In 2022, farm fresh is 3.61 times, in 2023 is 3.01 times, and in 2024 is 2.93 times. Number two is quiet ratio. In 2022, 2.80 times, in 2023 1.94 times, in 2024 2.01 times. Number three is average collection period. In 2022, 72.90 days. In 2023, 76.16 days. In 2024, 79.46 days. Number four is account receivable turnover ratio. In 2022, 5.01 times. In 2023, 4.79 times. In 2024, 4.56 times. Number five, inventory turnover ratio. In 2022, 3.09 times. In 2023, 2.676 times. In 2024, 3.80 times. Number six is debit ratio. In 2022, 39.51%. In 2023, 40.16%, and in 2024, 45.84%. Number seven is times interest earned ratio. In 2022, 6.81 times. In 2023, 5.33 times. In 2024, 5.04 times. Number eight, total asset turnover ratio. In 2022, 0.5 times. In 2023, 0.45 times. In 2024, 0.63 times. Number nine, fixed asset turnover ratio. In 2022, 1.48 times. In 2023, 1.52 times. In 2024, 1.64 times. Number 10, gross profit margin. In 2022, 37.16%. In 2023, 23.77%. In 2024, 26.66%. Number 11, operating profit margin. In 2022, 15.04%. In 2023, 10.11%. In 2024, 10.46%. Number 12, net profit margin. In 2022, 15.65%. In 2023, 7.93%. In 2024, 7.81%. Number 13, operating return on asset ratio. In 2022, 7.48%. In 2023, 5.99%. In 2024, 6.64%. Number 14, return on equity. In 2022, 12.97% in 2023, 7.91% in 2024, 9.13%. Next company is Dutch Lady Milk Industry. We will start with number one is current ratio. In 2022, 1.12 times. In 2023, 0.8 times. In 2024, 0.84 times. Number two is quiet ratio. In 2022, 0.59 times. In 2023, 0.32 times. In 2024, 0.37 times. Number three is average collection period. In 2022, 26.63 days. In 2023, 23.87 days. In 2024, 30.99 days. Number four is account receivable turnover ratio. In 2022, 13.71 times. In 2023, 15.29 times. In 2024, 11.78 times. Number five, inventory turnover ratio. In 2022, 4.3 times. In 2023, 4.21 times. In 2024, 4.04 times. Number six, debt ratio. In 2022, 52.99%. In 2023, 53.82 times. And in 2024, 53.26%. Number seven, times interest earned ratio. In 2022, 15.42 times. In 2023, 32.08 times. In 2024, 19.56 times. Number eight, total asset turnover ratio. In 2022, 1.59 times. In 2023, 1.52 times. In 2024, 1.35 times. Number nine, fixed asset turnover ratio. In 2022, 3.89 times. In 2023, 2.87 times. In 2024, 2.33 times. Number 10, gross profit margin. In 2022, 26.54%. In 2023, 29.69%. In 2024, 33.77%. In number 11, operating profit margin. In 2022 is 4.21%. In 2023, 6.93%. In 2024, 9.09%. Number 12 is net profit margin. In 2022, 3.45%. In 2023, 5.02%. In 2024, 6.69%. Number 13, operating return on asset ratio. In 2022, 6.68%. In 2023, 10.56%. In 2024, 12.24%. Number 14, return on equity. In 2022, 11.66%. In 2023, 16.56%. In 2024 is 19.26%.
Good day everyone. Before start, I will introduce myself. My name is Aina Shamini binti Sharu Asri. My metric number is A24P3774. Now, I will explain about liquidity ratio and focusing on current ratio and quick ratio of Farm Fresh Berhad and Dutch Lady Milk Industry Berhad from 2022 to 2024. Let's start with the current ratio. The current ratio makes sure a company's ability to pay off short-term liability using short-term asset. Farm Fresh Berhad recorded a high current ratio over 3 years, although it slightly decreased from 3.61 in 2022 to 2.93 in 2024. That shows Farm Fresh is significant to pay short-term debt with current asset. That means the company has good financial health. In contrast, the Slady Meat Industry Berhad had a significant lower current ratio from 1.12 in 2022, dropping to 0.80 in 2023, and slightly increasing to 0.84 in 2024. This means that the Slady may find it difficult to settle its short-term obligation without acquiring new financing or liquidity long-term asset. Next, we look at the quick ratio, which is a more conservative measure because it excludes inventory from current asset. Farmfresh Berhad maintained a strong and stable quick ratio. It's 2.80 in 2022 to 2.01 in 2024, reflecting its high liquidity status even after inventory exclusion from current asset. This illustrates the company's capability to settle immediate liability in terms of finance. However, the Slady quick ratio reached between 0.32 and 0.59, reflecting an extremely poor liquidity status. These goals indicate that the company is highly dependent on inventory turnover or external financing to meet current requirements. Now let's move on to the average collection period, which shows how long a company takes to collect payment from its customer after a sales. For Farmfresh Berhad, the collection period showed an increasing trend. It went from 72.90 days in 2022 to 79.46 days in 2024, showing a decreasing rate of payment collection from customers over the year. This can be a sign of inefficient in its credit policy or increasing credit terms. On the other hand, the Slady Meat Industry Berhad had a shorter and more efficient collection period, ranged from the value were 26.63 days in 2022, 23.87 days in 2023, and 30.99 days in 2024. This means better credit control and faster conversion of receivable into cash, improving its operating cash flow. In conclusion, Farmfresh may be more lenient with credit but face slower cash collection, while the Slady has better efficiency in converting receivable into cash. Next, we look at the account receivable turnover ratio, which tells us how many times a company can collect its receivable in a year. For Farmfresh, the turnover rate declined over time, 5.01 times in 2022, then down to 4.79 times in 2023 and 4.59 times in 2024. This shows the company not so good at receive money back from customer. But the Slady performed much better. It recorded 13.71 times in 2022, increased to 50.29 times in 2023, then slightly decreased to 11.78 in 2024. Thus, in lower a bit in 2024, the Slady is still better than Farmfresh. The Slady can receive cash from customer more quickly and have improved cash flow. In conclusion, the Slady clearly outperformed Farmfresh in terms of accounts receivables management, showing stronger efficiency and better control over credit sales. Now let's look at the inventory turnover ratio, which shows how many times a company sells and replaces its inventory in a year. For Farmfresh Berhad, the inventory turnover was inconsistent. It started at 3.08 times in 2022, dropped to 2.76 times in 2023, and then improved to 3.80 times in 2024. This reflects potential variation in stock control efficiency or demand. In comparison, Dutch Lady Meat Industry Berhad showed a more stable performance. The ratio was 4.300 times in 2022, 4.21 times in 2023, and 4.04 times in 2024. Dutch Lady revenues were higher each year than FarmFresh. This means Dutch Lady have better resources to store and distribute products. Net is the debt ratio, which indicates the proportion of a company assets that are financed by debts. Farmfresh Berhad showed a gradual increase in its debt ratio, increased 39.51% in 2022 to 45.84 in 4% in 2024, which is suggests of higher use of borrowed money to finance its asset. While it has increased its leverage, it still acceptable limits. Meanwhile, Dutch Lady debt ratio was higher over 53% throughout the duration. This indicates that the company is more leveraged and possibly at higher risk of financial loss, although it may also be taking advantage and take advantage of financing by debt. In conclusion, FarmFresh is increasing its leverage, but Dutch Lady remains more highly graded overall. Finally, we look at the time interest earn ratio, which measures how well a company can pay interest on its debt using operating income. FarmFresh Berhad had a declining time interest earn ratio, 6.81 times in 2022, down to 5.04 in 2024, registering a lower capacity to pay interest charges out of operating profit. Even with this drop, the ratio remained above reasonable levels, suggesting that earnings are still adequate to meet interest expenses. In contrast, Dutch Lady performed much better. It had a very strong time interest earn ratio of 50.42 in 2022, which increased to 22.08 in 2023, then decreased slightly to 19.56 in 2024. This indicates the company improved capacity to service its debt comfortably. In conclusion, Dutch Lady is in a much stronger position to handle interest expenses, while FarmFresh remains adequate but slightly declining in this area.
Assalamualaikum. Hi, my name is Nur Batrisha binti Mahdi and my matrix number is A24A3806. Today, I'm going to share about the last 7 financial ratio. For the total asset turnover ratio, FarmFresh show improvement in how they use their assets. The ratio went up from 0.50 in 2022 to 0.63 in 2024. This means they use their research more effectively to generate sales. However, Dutch Lady still perform better overall, even though their ratio dropped from 1.59 to 1.35. That drop could be mean their sales didn't grow as much or they invest more in asset without getting higher revenue. Next, when we look at the fixed asset turnover ratio, FarmFresh improved from 1.48 in 2022 to 1.64 in 2024. This shows they are using their long-term asset like machinery for more effectively. Dutch Lady started strong at 3.89, but their ratio fell to 2.33. That drop might be due underused asset or slow sales growth compared to their investment in equipment and facilities. The next part is gross profit margin. FarmFresh gross profit margin dropped to 23.77% in 2023, but bounced back to 26.66% in 2024. This showed they made efforts to control their cost of goods sold. On the other hand, Dutch Lady showed steady improvement, going from 26.54% in 2022 to 33.77% in 2024. This shows they managed their costs well and had a good pricing strategies that helped improve their profitability. After that, operating profit margin, or in short, OPM. Farm Fresh operating profit margin show a downward trend from 15.04% in 2022 to 10.49% in 2024. This might be caused by higher operating costs or less efficient day-to-day management. Meanwhile, Dutch Lady improved steadily from 4.21% to 9.09%, showing that the company is getting better at managing their core business operation and keeping costs under control. Now, let's move to the next part, which is net profit margin. FarmFresh experienced a big drop in their net profit margin from 15.65% in 2022 to 7.81% in 2024. This could be due to rising expense or lower profit after covering all costs. Dutch Lady, on the other hand, increased their net profit margin from 3.45% to 6.969%, which show better financial performance and stronger ability to turn revenue into actual profit. After that, operating return on asset ratio. FarmFresh operating return on assets slightly decreased from 7.489% in 2022 to 6.64% in 2024, meaning that their ability to generate operating profit from asset weakened a bit. But the steady ratio rise sharply from 6.68% to 12.24%, which means they become much more efficient at using their asset to earn profit. Lastly, return on equity, or ROE. FarmFresh return on equity dropped from 12.97% in 2022 to 9.13% in 2024, showing a lower return from shareholder during that time. But Dutch Lady's ROE increased strongly from 11.66% in 2022 to 19.26% in 2024, which means they use shareholders' funds more efficiently and delivered better value to investors.
My name is Nurin. Today I will be presenting recommendation for both Farm Fresh Berhad and Dutch Lady Meat Industry Berhad based on their financial performance between 2022 and 2024. For Farm Fresh, while the company shows strong liquidity, there are areas from improvement. First, they should control operation costs through technology and cost analysis. Next, they must enhance receivable management by adopting electronic billing. They also need to reduce their reliance on debt, shifting towards retained earning or equity financing. Lastly, enhancing market placement through digital marketing and product innovation will support growth. For Dutch Lady, although profitability is rising, liquidity needs attention. They should strengthen working capital and restructure current asset. Like Farm Fresh, they must optimize receivable using digital tools and also lower debt levels through internal funding. To stay competitive, they should expand their reach to new consumer groups and improve digital engagement.
Good day everyone, my name is Amira binti Isha. My metric number is A24B305. For this part of our analysis, we will present the right source of fund for both FarmFresh and Dutch Lady to support their expansion plans. Our suggestions are based on their financial performance and long-term goals. For FarmFresh Berhad, we recommend government grants and equity financing. Since the company is listed, it can raise capital by issuing new shares. This help fund expansion like opening more Farm Fresh Mart or entering Asian market. The company's debt ratio is increasing, so using equity instead of loans help reduce financial risk. FarmFresh also promote sustainability and health living, which make them eligible for grants or soft loans from the Malaysian government. As for Dutch Lady Meat Industries, we recommend use retained earnings and corporate bonds. The company is financially strong with increasing net profit and return on equity, so it can use its own profits to expand operations. By using retained profits and bonds, Dutch Lady avoids diluting its ownership. As a subsidiary of Friesland Campina, they have a strong reputation and can issue bonds at a low cost for long-term capital needs. In conclusion, both of companies should select the most suitable funding based on their financial position. FarmFresh should focus on equity and government support, while Dutch Lady can use its internal profits and bonds to grow without giving up ownership.